Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum.
Our fund mirrors SciTech GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the SciTech GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
Hello, this is the Global View here at Ausbiz on a Tuesday. I'm Andrew Gagan. Good to have you with us again. Let's check what happened overnight. Equity markets edging lower as investors prepared for a data-heavy week and geopolitical developments. While on the trade front, President Trump extended a tariff truce with China by another 90 days. Wall Street's main indices ending lower as investors await US inflation data. Shares of Nvidia and Advanced Micro Devices were in focus on news that the semiconductor giants had agreed to give the US government 15% of revenue from sales of their advanced chips to China. Micron Technology raised its forecast for fourth quarter revenue and adjusted profit. Intel, its shares up after a report there that the chief executive had visited the White House. This after President Trump had called for his removal last week. And TKO shares surged 10% after Paramount bought the rights from the live entertainment company to exclusively distribute UFC events for the next 7 years in a deal valued at $7.7 billion. Well, President Trump has signed an exclusive order extending a tariff truce with China by another 90 days. Imports from China are currently subjected to a 30% tariff, and President Trump has also pushed for additional concessions, urging China to quadruple its soybean purchases. Elsewhere, Federal Reserve member Michelle Bowman saying she favours 3 rate cuts this year, saying a cut at the next meeting in September would help avoid a further unnecessary erosion in labour market conditions and reduce the chance that the committee will need to implement a larger policy correction should the labour market deteriorate further. Meanwhile, US Treasury Secretary Scott Bessent saying he's expanding the search for Jerome Powell's replacement as Fed chair, saying that current governors Michelle Bowman, Phil Jefferson and Laurie Logan will be interviewed. Well, let's just get to those Treasury yields in the US, slightly lower ahead of tonight's highly anticipated July consumer price inflation report. The yield on the 10-year down to around 4.27%, the 2-year at close to 3.75%, and the US dollar firming ahead of that inflation report. The Aussie dollar currently at 65.1 US cents. Bitcoin is trading at around 118,000 US dollars. Oil prices little moved, having fallen more than 4% last week as investors look towards talks this week between Presidents Trump and Putin over the war in Ukraine. Brent crude futures at $66 a barrel. Copper's down about 0.5%. Iron ore rising close to 1.5% at $102 US dollars a tonne. And gold has fallen after President Trump said tariffs would not be placed on imported gold bars. Spot gold down 1.5%. Let's get across what we're seeing on Wall Street at the moment. Steve Sosnick is joining us from Interactive Brokers. Steve, welcome back. So, what did you note on trading on your Monday? Given, I guess, as I mentioned there, the focus really is on that forthcoming CPI read.
Good morning, Andrew. Yeah, that's basically the best way to read it. I'm not quite sure whether to better term it as consolidation of Friday's fairly aggressive move without a known catalyst, or a bit of a little profit taking ahead of anticipation about the CPI number. Either's plausible, both are possible, probably some of each. The headline, the monthly core number is really the one that people are going to be looking toward, and that one is expected to come out at 0.3% rise. Which quite frankly, if we put together a bunch of point threes, even though CPI is not the preferred measure, the PCE deflator is, that, start to add up point three, multiply that by 12, and you start to realize that we're trending in the wrong direction as far as inflation goes, and that could present some problems for the Fed. Let's see.
Nonetheless, as I mentioned there, I mean, the recent commentary from Fed members obviously pushing for a rate cut in September.
Yeah, some of them have come over to the side of leaning toward a rate cut. It also will have to do with whether the new appointee, Stephen Miran, can get approval before then, because he would almost certainly be pushing for a rate cut. And so there's definitely movement in that direction, but they are data dependent. And I think one of the reasons, remember, they changed from not wanting or needing a rate cut to coming around on the idea, and I'm thinking about like Mary Daly and Neil Kashkari and some others, is because of the data, the jobs numbers. There's no way to sugarcoat them, as you know. They kind of stink, and so again, with the dual mandate being full employment, well, that doesn't move us any closer to full employment and stable prices. Well, as of now, the data can be stable-ish prices. So it's understandable why they would have moved toward leaning toward a cut as opposed to away from one.
Meanwhile, Steve, does the market care about tariffs anymore? It's like I say that because obviously we've got that extension of the 90-day extension for China. Look, little reaction to that.
No, in a piece on Thursday that you can find on ibkrcampus.com, is I basically declared the taco trade dead, and it's not clear that it really was ever a thing because as of last week, the tariffs went into effect Thursday, and market didn't care. So by that definition, if you thought that the market was rallying because the president would back off or offer more moratoria, et cetera, guess what? He's not, and he didn't. Yeah, there's still the 90-day pause on China. There's still some stuff that needs to be negotiated, certainly with several other countries. Certainly, as threats with Brazil, India, China, and Mexico. There's still unresolved issues, but for the most part, the tariffs are here, and the market yawned. And so the question then is why? It makes me think that the taco motif was a head fake, and that we were really just in the throes of a big momentum trade, and nothing we've gotten so far has been sufficient to disrupt this powerful trend, this momentum trade that we've been seeing, with enough force to disrupt it.
Yeah, well, in fact, further to that, so you talk about MOMO and FOMO continuing to drive the market there. Nothing seemingly is going to derail it.
Well, it's almost like Newton's first law of markets. A market will stay in motion until acted upon by a sufficient force, and we haven't had that sufficient force. We did for a little bit in April, but then that I would say the president changed his mind rather than chickened out. But because he began to talk in more market-friendly terms where he was not doing so before, and that I think was really one of the changes. But since then, we've really just the momentum feeds upon itself, until of course it doesn't. But right now, the trends are so strong, they're so deeply entrenched. People are so afraid of missing a buyable dip. I've also said that the half-life of dips has been shrinking dramatically because everybody's so afraid to miss a dip that they're gone really quickly for the most part. And so this is where we're going. Where it ends, I don't know. The longer it goes without a break, probably the more nasty it gets when it's time to break, because I do think that markets have a nasty way of making the maximum number of people wrong at the most inopportune times. But in the meantime, this is the trend. These are the trends, and this is what we're seeing.
So, given that, Steve, given the market continues to set new records, where do you want to be, and what are you avoiding?
I think we go back to the idea of don't fight the tape, but insure against it. We're starting to see we're seeing VIX with a 15 handle again. It's not expensive to insure against a drop. The momentum is by far the strongest in the mega cap tech sector. Shouldn't surprise anybody, right? I think consumer discretionaries have been particularly problematic. The reads on the consumer are not very good. Ultimately, it's very hard to reconcile a weak consumer with a strong economy. But again, the economy and the markets can diverge for some time. The market is so enamored of the AI trade. It's a very difficult. You can't really fight this right now, and so as a result, perhaps the best course of action is hold your nose and use tight stops and or puts to protect your position. I hate to say jump on this trade because again, this thing can unravel quickly and unpredictably. But as of now, don't fight the tape is kind of one of the things that keeps echoing in my mind.
Yeah, and at school we continue to see that leadership from those mega cap tech stocks. And as I mentioned earlier there, Nvidia, AMD, there's that 15% tax on chips sold to China. How is that likely to play off? I mean, have we seen much reaction to that?
Well, here's the thing. So Nvidia was down mildly. AMD was up a bit because it's bouncing off of the lows because, again, got to buy every dip. The stock dipped after earnings, and so now everybody's crawling in to buy it. They rallied on the news that chip sales would be allowed to China. In theory, they should have had a little bit of a hit because those sales are now only worth 85% of what we thought they were going to be. But the market, so what? You know what? Okay, they're selling the chips, big deal. And there were allusions that the president made toward 20% and on other chips. But this is again, it's not, the market's not focusing on a lot of the details all the time. It's more the vibes, and it's that, okay, the chips are getting sold to China. And so still there's going to be, we're better on that front than where we were a couple of weeks ago. And so, again, the attitude here is, so what if those sales are going to be 15% less lucrative than they were before? This is not a market that's dealing a lot in in-depth analysis. This is a market that's dealing in vibes and MOMO and FOMO and et cetera.
Steve, enjoy the rest of your week. Thanks for joining us from Interactive Brokers.
Thank you, Andrew. You too.
Let's return to the local market as we're just ahead of the open and we are expecting a mildly negative open. SPI futures are down around 0.1%. And of course, the big event today is that decision by the Reserve Bank. Expectations it will cut by 25 basis points, some even going as far as perhaps a 50 basis point cut. That will be revealed at 2:30 Eastern. We'll get right across that when we have a special rates live show. Join us for that. Stay with us for the open.